Hello, everyone, and thank you for joining us today for the first OIC webinar of July, where we're going to talk about credit vertical spreads. We're going to talk about their risk dynamics and their characteristics, as well as the optionality that's inherently built into them. Today, we're going to dig into the broad characteristics of spreads themselves. We'll talk more specifically about call credit spreads and put credit spreads. And I'm going to give you some theoretical examples of how these spreads might look if you have them on in your own trading account. Now, my hope is that this webinar, along with its sister presentation on complex spreads next week, will both give you a deeper understanding of the dynamics of these spreads, allow you to see them in their most theoretical form as we talk about them today, and then hopefully be able to apply that understanding when you're looking at an option matrix that's right in front of you and see how those theoretical ideas are playing out right in front of you as far as option prices are concerned. My name is Matt Cashman. I'm a principal of investor education at OCC, as well as an options industry council instructor. Quick background on myself. I started trading around 1998. I've been an options trader ever since. I got my start in Chicago on the floor of the CBOE, trading equity and index options. Quickly after that, I moved to London and I traded interest rate options there for about 3 years. And then eventually I moved back stateside, where I started and ran an index options market making operation for the better part of about a decade in Chicago, again on the floor of the CBOE. Currently, I work at OCC helping individuals and investors to better understand both the risks and the benefits of exchange-traded options through efforts like the webinar that you're watching today. Now, we always include a disclaimer to make our lawyers happy. Let me pull that up. Sorry. Just a little bit of little technical difficulties, no big deal. Here's our disclaimer. Options involve risk. They're not suitable for everyone. Any strategies that I use in my discussions, including examples, actual securities and price data, strictly for illustrative and educational purposes. They should not be construed as a recommendation, an endorsement, or a solicitation to buy or sell securities. Past performance is not a guarantee of future results. One other bit of housekeeping. These are the following trademarks, logos, and service marks are owned by the Options Clearing Corporation. You're going to see them used throughout the presentation today. Now, a little bit about OIC. Many of you have been with us before on some of these webinar journeys. If this is your first webinar journey with us today, let me give you a little background on OIC. The Options Industry Council is the educational arm of our parent company, the OCC, or the Options Clearing Corporation, which is right here. OCC is the largest clearing corporation of equity and index exchange traded options in the world. Now, OIC started out as a collective in 1992 to better educate the public as to the risks and benefits of exchange traded options. Currently, we continue to pursue that goal mainly through the utilization of our website, optionseducation.org, which you'll see right here. There, you're going to find online courses, podcasts, videos, trading tools, and webinars like the one you're listening to now. It's important to recognize we are able to provide these services free of charge to the public because we are fully funded by our parent company, OCC. Now, I work on a fantastic team at the OIC. We call it the Investor Services Desk or the Investor Education Desk. I sit there with 3 other colleagues, 2 of which are answering your questions via the chat today during our presentation. Please make sure to say hello to Ken and Roma when you ask questions, and be patient, as oftentimes lots of questions come in at the same time. They're going to do their best to get you an answer as the webinar is happening. If you don't get an answer to your question today, you can always send us email questions related to options at options@theocc.com, this email address right here. This, again, is a free service that we extend to the public as well. It's important to note we're not registered investment advisors, so we can't direct you on trades or suggest investment strategies. But what we can do and what we love to do is help with general questions about options, optionality, and theoretical knowledge surrounding the options ecosystem. Amongst the four of us that sit on that investor education desk at OIC, we have over 100 years of combined industry experience surrounding options. And we're always happy to help in whatever way we can to further advance your understanding of options and how to responsibly use them in your investing. So make sure you send us email questions at options@theocc.com. It's a fantastic resource that, in my opinion, does not get utilized enough. So let's start with annual options volume. This is a graph of that very metric from 2000 to 2023. We really consider this to be the modern era of options trading. It encompasses the advent of high-frequency trading, which started around 2000, and also many different events within this time period. Obviously, the Great Financial Crisis in 2008, the European debt crisis in 2011, and then obviously COVID hits us right here in 2020. The reason why I always start option presentations with this slide is because I think it's important to drive home the idea of how much more volume there is now than there was previously. If you think about 2008, I was standing in the SPX pit trading options. At the end of the year, 3.7 billion contracts had hit the tape all year long. And I thought that was the craziest thing that I had ever seen or would ever see. If you take that and contextualize it within the context of all of these years, you can see that last year we did about 11.3 billion contracts. And if you look at the data from OCC that's projecting out this year's totals, it looks like this year is going to be north of 12 billion contracts. What that means from my seat as an options educator is that it's vitally important that everyone understand who's involved in this marketplace, which happens to be a lot more people than used to be, that everyone understands how the basics of these options work because they're leveraged contracts. And it's important that you understand the risk that you have on before you start to put that risk on and how the dynamics of that risk work. So with that said, let's get right into the heart of what we're going to talk about today. We're going to keep it pretty broad at first. We're going to talk about an overview of vertical spreads just in general. How do spreads work? What are they? When people talk about spreads, what does that mean? I know that word gets thrown around a lot, but we're going to talk about general spreads, and then we're going to dig into some pretty specific examples. Call credit spreads, put credit spreads, and then hopefully we'll have some time for some Q&A afterward. Let's get right to it with an overview of vertical spreads. The thing that we have to talk about when we talk about vertical spreads is that buyers have rights when they are buying options. Option buyers exercise those rights by exercising their option contracts. Sellers, in contrast, have obligations. Option sellers incur obligation to fulfill the terms of that contract via the process of assignment if they are assigned. Now, why do I build this into an actual presentation about spreads? The reason why is because option spread positions carry both long and short option positions, generally speaking, on different strikes. And thus, you most of the time when you carry an option spread position that has both long and short contracts in one spread, you're going to have both rights and obligations. And whether you have those rights or obligations is going to be dependent on where the stock is relative to the strikes that you have on. The rights and obligations are inherent within the options. And so that part of it doesn't change. However, when the stock moves around relative to the strikes that you're either long or short, your position is going to react to that movement, and you're going to be financially either incentivized to exercise those rights, or you're going to need to be able to forecast a situation where you might have to incur the obligation of making the contract that you're short hole for someone else who's actually exercising. So I think it's important that you understand the basics of these spreads and how when you have a spread on that has long and short positions, that you have both rights and obligations within one actual option trade. So let's talk a little bit more specifically about a spread transaction. Spreads involve two or more positions, generally one versus the other. It's usually one buy or sell of an option and another buy or sale of another option. Generally speaking, you're going to be doing this on the same underlying most of the time. When people start, especially when they start kind of dipping their toe in the water, in the proverbial water of spread trading, you're likely to be starting with the same underlying and generally with the same expiration date. Now, spreads can obviously have different expiration dates as well, but those are called time spreads. We're not going to talk about those today. If you have questions about time spreads, make sure to send us an email and we can talk until we're blue in the face about time spreads. But usually they'll have the same expiration date, and it's likely that they'll have different strike prices, especially with the spreads that we're going to be talking about today. Possibly these spreads are going to have different quantities. However, when you're starting to trade these spread transactions, a lot of times people like to keep the spreads what we call one-to-one. Why is that? The reason why is because most of the time when you're first starting out and understanding the dynamics of these positions, it's important to think about keeping your rights and your obligations matched up one for one. So it's important that you consider that as part of the risk matrix of spread transactions, and that you only really start to think about different quantities of these spreads when you understand the basics of how they work. Now, spreads can also involve stock positions. There are spreads that are considered stock and option positions combined together. Those are things like married puts, which would be long stock and long downside puts at the same time, or something like a covered call, which can be traded as one priced option. Sometimes that's referred to as a buy right. That would be long stock and short upside calls against it. Sometimes people are going to talk about that as a spread. Within the context of our conversation today, I'm not going to talk about those as spreads, but it's important that you understand that sometimes people talk about those things as spreads as well. Don't just think about spreads as only call spreads or put spreads. There's lots of different ways that those things can be combined, and sometimes people do reference spreads that have stock involved with the spread. All right, let's talk about vertical spreads. You're going to be buying one option and selling another option. That's the basis of what we're talking about here. And vertical spreads are on the same underlying and the same expiration, but they have different strikes. They generally have defined risk reward characteristics. This is part of why people like trading them, because they know as a function of these defined risk and reward characteristics what they're getting into. You don't have something that has open-ended risk when you're trading a one-for-one spread. It's defined. How is it defined? It's defined by the exact thing that I said when we started. Option buyers have rights, option sellers have obligations. And so your defined risk is going to be defined by where you have those rights and where you have those obligations. On in both call spreads and put spreads, there's two main types of spreads: debit spreads and credit spreads. Now, you can do this with calls and puts on both sides: call debit spreads, put debit spreads, and call credit spreads and put credit spreads. What's the difference between them? Well, it's right here in black and white. Debit spreads, actually, you pay or debit your account to initiate this position, meaning the option that you buy is usually going to be bigger than the option that you sell. Thus, you're going to be paying and some amount, which is going to be debited from your account, and then you will have on what we would call a debit spread. What we're going to talk about today is the credit spread, where you receive the premium to initiate this position. You're going to be collecting premium in order to sell these credit spreads. What that means is the exact opposite of the debit spread. The option that you're going to be selling is generally bigger than the option that you are going to be buying. So let's talk about call credit spreads specifically. Why is someone going to want to trade a call credit spread? The investor motivation here is a neutral or a bearish outlook on the underlying. Generally speaking, people trade call credit spreads, meaning you're going to be selling this spread when you're neutral or bearish on the underlying. The reason why is because calls are theoretically positively correlated to underlying movement of the stock. What does that mean? That means that generally speaking, not all the time, but generally speaking, calls go up in value when stocks go up in value. They're positively correlated. Their price is positively correlated to the underlying. And so if you're going to be selling this call spread, you're going to want a neutral or a bearish outcome in order for that spread to be theoretically profitable. Call credit spreads, like most spreads, have defined risk and reward, as do put credit spreads. Their break-even points, the break-even point for your spread is defined by the credit that you receive. So what this says is favorable break-even points, credit received moves break-even point. That means the more credit that you take in when you sell a call spread, the more kind of what we would call cushion you're building into a P&L graph. I'll show you what that looks like when I give you the P&L graphs for both these call credit spreads and put credit spreads. But it's important that you understand your break-even point is going to be directly correlated to how much premium you actually take in when you sell the spread. And that's what this means, right? Profit is potentially heavily influenced by the amount of the credit received. So the more premium that you take in, the bigger the difference in where your actual break-even point is going to be on your P&L graph. I'll show you those. This is something that I think is really important that we build in to the conversation here. Risk control surrounding spreads, and particularly credit spreads. Remember, spreads themselves generally have defined profit potential and defined max loss numbers. That's the reason why you hear that word thrown around a lot, defined risk. That means that you have defined risk, you have defined profit on both sides. You know how much you can either make or lose based on the price that you entered into this spread. But what that also means is that position monitoring is really important when you start to understand how the dynamics of the risk of these spreads work, because you have long and short options built into them. This is not the same as just being long stock and short an upside call. This is not the same as having just a regular upside call position in a stock, or a downside put position. We're talking about something that has both defined profit potential and defined max loss, but it's also important that you understand, where are my short strikes, where are my long strikes relative to where the stock is trading. So position monitoring becomes more critical when you have both long and short positions in these options. Let's talk about a real world example here, or a theoretical real world example. The stock would be trading 88.5. This generic XYZ stock is trading 88.5. You've got 28 days to X. With the stock trading 88.5, if we're going to talk about a call credit spread example, what I thought would be really instructive is maybe one of those call credit spreads that people might use most readily, which would be the generic kind of like gently upside version of the call credit spread. In this case, it's the 90-95 call credit spread. These are the 28-day 90 calls for $3.50 and the 95 calls for $1.80. Now, you're selling the 90 call for $3.50 and you're buying the 95 call for $1.80. What does that generate? It generates a net credit of $1.70. That's the difference between the option that you're selling price and the option that you're buying, that price. Now, what does that mean as far as the actual amount of premium that is in your account. When you sell an option, you are immediately credited the premium that is associated with that option. And when you buy an option, you are immediately debited the premium that is associated with that option. So in this case, you're debited the $1.80 that you bought this call for, and you're credited the $3.50 that you sold that call for. What that ends up with is a net credit of $1.70, but you have two positions on. You are short the 90 call and you're long the 95 call. If you were to put this trade on and then take your sheets and slide them over the table to me, I would look at them and say, great, you are now short the 90-95 call spread. And that's kind of how we would talk about it. You're short the 90-95 call spread. This is a neutral or a bearish call spread, because if you don't have anything else on and you're short the 90s and long the 95s, and they're both calls, the actual price of that spread is going to be generally positively correlated to the underlying price. So most of the time, as the underlying goes up, that call spread is going to go up in value most of the time. And when the stock goes down, that call spread is theoretically going to go down in value. That's what the positive correlation means here. That's the reason why people who are neutral and or bullish sell these call spreads. Now, let's dig a little bit more into call credit spreads and what that example looks like from a P&L perspective. When you have the 90-95 call spread on and you're shorted, which we just talked about, you sold the 90s, you bought the 95s, you collected $1.70. Anytime you sell a spread like this, a vertical spread, the most that you can make is how much you collected when you sold. And that happens when the spread goes out without value. If you sold it for $1.70, which you did in this case, and the spread goes out without value, you keep the $1.70 in premium. And in fact, the $1.70 in premium, just like I said, is credited to your account immediately and stays in your account. It's a question of where the stock is after or at the point of expiration as to whether or not this actual spread is worth more or less than $1.70. So let's talk about where and how it might be worth more or less. Remember, the max profit of a spread like this is what you sold it for. So below 90 to the downside, anywhere below 90 at expiration, this spread is theoretically going to go out worth zero or without value. And thus you would be keeping the $1.70 that you collected when you first sold the spread. Now, above 95 is where this spread incurs its max loss. Now, keep in mind, this is defined loss. The reason why this P&L line is straight across is because it's defined. It doesn't move when you go past 95 to the upside. This is the most you can lose on this spread. Now, how is 330 the most you can lose on this spread? The most that this call spread can be worth is the difference in strikes. So we look at this and we say this is a 5-point call spread or a $5 call spread. Why is that? Because the bottom strike is 90 and the top strike is 95. The difference in those strikes is $5. If you have this on 1-to-1, which you do in this case, the most this call spread can be worth is $5. Well, remember, I told you that when you sell it, you keep the $1.70 in your account. So if the stock goes out above 95 and this spread is worth the most that it can be, it would be worth $5. And in that case, because you keep the $1.70 that you sold it for, your max loss is going to be $3.30 in between those two strikes. All right, so back. The one thing I want to bring to really drive home here is that your break-even point. Remember what I said when I said that, like, the actual break-even of this spread is influenced by how much you sold the spread for, how much you actually bring in premium-wise when you sell it. Your break-even here is $91.70 because the $1.70 that you sold and that you credited your account when you sold this spread gets added to that bottom strike. If the stock goes out below 91.70, you are going to be positive on the positive side of your break even. If it goes out above 91.70, that's where this max loss starts to kick in above 95. Between 91.70 and 95, this is why this line has some tilt to it, because that's going to be how much you're going to be losing between 91.70 and 95. It's going to be some percentage of this $3.30 of max loss. Here's what we need to talk about as far as expiration is concerned. You have three main possibilities as far as expiration. I want you to think about this. You're short the 90s and you're long the 95. You have the 90-95 call spread. In this case, you have basically three expiration considerations. You have below 90, right? The stock goes out at 90 or below, in which case we talked about that stock, that option spread going out without value. You have above 95, where it's actually worth the most that it can be worth. And then you have in between 90 and 95. Let's look at all three of these individually. Stock is below or equal to 90. Remember, you sold this spread for $1.70. We're talking about the stock going out between, anywhere below 90. In this case, both of these options are theoretically going to go out worth zero without value. And you are going to keep the $1.70 that you sold the spread for. There is one potential risk that you need to keep in mind, and that is this assignment risk. If the stock goes out very close to 90, remember I said stock is below or equal to 90, uncertainty of assignment is much higher when you're closer to 90 than if you're way below 90. The reason why is because you don't necessarily know where the stock is going to be right as it expires. If you're close to 90 and you get assigned on your 90 calls, that's going to result in a short stock position from that strike price, from 90. You're going to be selling the stock to someone else. You're going to be incurring that obligation to make that contract whole if someone else exercises that call and creates a long stock position. So below 90, both of these calls go out worthless and you keep the $1.70. If you're close to 90, you need to think about whether or not you have a likelihood of being assigned on that short call. Now, above 95, this is where the actual call spread is worth the most that it can be worth, anywhere above 95. And remember, what is the most that a 5-point call spread can be worth? The difference in strikes. So the 5-point call spread can only be worth up to $5. Your max loss is the difference in strikes minus the $1.70, the premium that you received, or $3.30. In this case, your 90 call is likely to be assigned. Remember, you're short the 90s and long the 95s. And if your 90 call is likely to be assigned and you do get assigned on it and the stock is trading well above 95, remember, this spread has both obligations and rights in it. Where's the obligation part? The obligation is in your short option. Where are the rights? The rights are in your long option. And so ostensibly what is happening here if the stock goes out above 95 is that you are short stock from 90 because someone is probably going to exercise that 90 call, and you would be incurring the obligation of making that whole. And then above 95, you size your 95 call. And so really the P&L of this whole thing is because you're short stock at 90 and long stock at 95. You can think about it that way, as that's why this $5 call spread actually goes out worth $5 at that point in time. And that's why the P&L ramification is that. It is essentially synthetically like selling stock at 90 and buying it back at 95. But what you've done is already collected $1.70 in premium, which offsets some of that. And that's why you end up with this $3.30 as max loss above 95. Now, let's talk about the actual interesting part of this, which is between 90 and 95. Remember, you're short the 90s and long the 95s. And so if the stock doesn't go all the way through past 95, what you end up with is a situation in which you might be assigned on this 90 call, which creates a short stock position from 90, and then would possibly necessitate some margin required. And it's possible that if the stock goes out in between 90 and 95, that your long call at 95 expires out of the money or without value. Because if the stock is not above 95, you're not really financially incentivized to exercise your 95 call. Remember, if you're exercising that 95 call, what are you really doing? You're essentially creating a synthetic long stock position from the strike price. From the strike price in this case would be 95. If the stock's trading 92, do you really want to be exercising your 95 call and buying stock at 95 when you might be able to buy it in the actual free market for 92? That's a decision you have to make and that everyone has to make on their own. However, in this case, between 90 and 95, what you need to keep in mind is that the short option that you have in your portfolio is likely to be assigned. And the long option that you have, where you actually still maintain the right to exercise, is probably going to be in a situation that is not financially advantageous for you to exercise. And so you need to understand what this means as far as your position is concerned and whether or not you're comfortable carrying a short position, or if your actual account allows you to carry a short stock position. Now, if you're long the underlying stock and you actually get called away on your 90 calls, you actually just deliver the stock that you have in your position already. But if you're selling this 90-95 call spread and you don't have the underlying stock in your position, it's possible that being assigned on your 90 call and not being in a situation where you want to exercise your 95 call would create a short stock position. And you need to understand the risk ramifications of that as far as your account is concerned. Now let's talk about pin risk. What is pin risk? Pin risk is the risk of the stock basically going out at or very close to your strike. And that really is whether you're short the strike or long the strike. You can have pin risk when you're long the strike. You can have pin risk when you're short the strike. However, pin risk when you're short the strike creates a significant amount of uncertainty. The risk here, and what you need to understand, is that because you're short that option, because you have incurred the actual liability of making that contract whole, if someone else exercises, you don't know whether or not you're going to get assigned. That's what pin risk is all about. Pin risk is about uncertainty as to whether or not you're going to be assigned. So if you are selling that option, you need to be aware of that uncertainty as the stock gets closer and closer and closer to your short strike. And you need to be paying attention as to whether or not your brokerage firm is letting you know that you have been assigned on those short options. Remember, there is significant overnight gap risk and potential commitment of capital, like the margin that we talked about, if you're assigned on a short call and you don't necessarily have the stock already in your portfolio to be able to deliver. That's something you need to work out with your brokerage firm as to whether or not you're actually allowed to carry that risk, or how much your brokerage firm is going to charge you in order to allow you to carry that risk. But it's important that you understand that pin risk starts to happen as the stock gets closer to that short strike. Pin risk can also happen at the long strike. But pin risk at the long strike is different. Pin risk when the stock is trading closer to your long strike is really about, do I want to exercise? Do I think that it's in my financial best interest to exercise? Or do I want to exercise in order to counteract maybe an assignment that has already happened? And so that's a different kind of pin risk. The main difference and characteristic of that pin risk is that in one case, you don't have the actual control, and in one case you do have the control. In situations where you're pinning a long strike, you have and maintain the control to exercise. In a situation where you're pinning a short strike, you are at the whim of the assignment process. Important to understand that difference. Let's talk about the put credit spread. You're going to look at this and say, Matt, this looks an awful lot like the call credit spread, and you are right. It does. It just has a totally different P&L shape to it, and that's important. So put credit spreads are very similar to call credit spreads, but just in the opposite direction. Put credit spreads, people generally put on if they are neutral and or bullish on their outlook of the underlying. Why is that? Because puts, while calls are positively correlated to underlying price movement, puts generally have the opposite of that. They are negatively correlated to underlying price movement. And so when stocks go up, puts generally go down in value, whereas calls go up in value because they're positively correlated. However, the actual optionality that exists within these credit spreads is the same on the put side as it is on the call spread. You have defined risk and reward because of the inherent optionality that exists in carrying both a long option position and a short option position on two different strikes. That does not change between the call spread and the put spread. Again, the same thing is true here. Favorable break-even points come from the credit that you're receiving when you sell that option that is bigger than the option that you're buying. And the profit potential is heavily influenced by the amount of that credit that you receive. The more credit that you create when you sell the spread, the larger the cushion that is going to be built in to how your P&L graph looks and where the break even is. Now, the risk control is exactly the same on the put credit spread as it is on the call credit spread. It has defined profit, defined max loss, and again, because you have both a long and a short position in one spread position, it's really important that you start to think about your position monitoring. Position monitoring means, where are my short options? Where are my long options? And where is the stock? Those are the things you really need to keep in mind when you're monitoring positions. Does this short put that I have in my position, how does it act? What are the risk dynamics of it? Is the stock close to that strike? Is it far away from that strike? How much premium is in that put right now? And then contrast that with the long put that's theoretically below that strike and look at the same dynamics of that put. How do those two dynamics work in concert with each other relative to where the stock is? That's what position monitoring means. Let's talk about a real kind of a real-ish world example. We're going to use the same theoretical stock. XYZ is trading 88.5, and we have 28 days to expiration. In this case, remember, the 88.5, the stock is trading 88.5. We're going to look at the slightly downside put spread. You'll be selling one of the 28-day 85 put at 205 and buying one of the 80 put, the next strike down, for 70 cents. In this case, the credit that you are receiving is $1.35. Now, the actual P&L of this situation looks almost exactly the same as the call credit spread, except the P&L is flipped. Down versus up, up versus down. In this case, if you were to put this trade on, and again, slide your sheets over the table to me, I would look at it and say, okay, you're short the 85-80 put spread, or some people call it the 80-85 put spread. Oftentimes within different actual option classes, people have different nomenclature as to how they actually, what order they say the order of the strikes. Sometimes people like to go from the bottom up no matter what. And so in this case, they would say the 80-85 put spread. Sometimes people like to talk about the leg of it that you're long first. And so in this case, they would say the 80-85 put spread. But oftentimes, other people like to talk about it in different ways. So you can either say the 80-85 or the 85-80 put spread. Once you start to get comfortable with talking about it in terms of strikes, people are going to know exactly what you're talking about. However, this is a neutral or bullish put spread because being short the put premium actually is negatively correlated to the underlying price. Puts, generally speaking, go down in value when stocks go up. Generally speaking, they go up in value when stocks go down. Let's look at a P&L of this. So selling the higher strike put and buying the lower strike put, you're going to be selling the 85 put and buying the 80 put. Remember, you're collecting 135. In this case, it doesn't matter whether you're selling puts or selling calls. The actual credit that you create when you sell these options, or this option spread, I should say more specifically, gets credited to your account immediately and stays there. What that means is that the most you can make on this spread is what you sold it for. Just like when you're selling the call spread, the most you could make is what you sold it for. So selling the 80-85 put spread for $1.35, you're never going to make more than $1.35. And that happens when you're above the 85 strike and both of these options go out without value. Here's your max loss between or below the 80 strike. Why is your max loss 365? Remember, you collect 135 when you sell the spread. What's the most the spread can be worth? The difference in strikes. If you go out below 80, this put spread is going to be worth its maximum amount of $5, but you've already collected 135, and so your max loss below 80 is $3.65. The interesting part, again, happens between 85 and 80. And in this case, your break even is 83.65. Why? Because 85 minus $1.35, the credit that you received, this is that kind of what I call the cushion. This $1.35 of premium is the cushion below the 85 strike where you still have room before your break even gets reached at 83.65. Let's talk about the expiration considerations on this. It's exactly the same as the call spread, but the opposite way. So you've got three potential outcomes: above 85, below 80, or in between. Above 85, both of these options are theoretically going out without value. Your 85s and your 80s are theoretically going to go out worth zero without value, and you would get to keep the $1.35 in credit that you took in when you sold the spread. Below 80, we'll talk about in a second, and in between, we'll address also. However, again, assignment risk starts to happen when you get close to the strike that you're short. You get uncertainty of whether or not you're going to be assigned on these puts that you're short, the 85 puts. And so you need to think about the potential of having a stock position from an assigned option after the fact. Important to note here, when you're short calls and you get assigned, you actually create a synthetic short stock position. When you're short puts and you get assigned, you actually end up with a long stock position. Why is that? Because the person who's long the put is exercising their put and they are selling. Their right when they buy the put is the right to sell the stock at the strike price. They are selling the stock, and thus you are making the contract whole. You are incurring the obligation to make the contract whole. If someone is selling stock and you're making it whole, you're going to be buying the stock. And that's why when you're short puts and you get assigned on them, you actually end up long stock. So in this case, stock above or equal to 85, both of these puts theoretically go out worth value. You keep the $1.35. Below 80, this is your max loss area, $3.65 here, because the put spread is worth $5, but you've already taken in 135. And then in between 80 and 85, this is when things get interesting. When the stock goes between these strikes, you might be assigned on your 85s, but you might have to make a decision as to whether or not you want to exercise your 80s. Remember, if you get assigned on the 85s and you exercise your 80s, you are synthetically buying stock at 85 and selling it at 80. That's where that $5 difference comes into play as far as the P&L is concerned. However, you get to keep this net credit no matter what. So if the stock goes out in between 80 and 85, you need to do the same kind of mental calculus that you would have done on the call side if it goes out between those strikes. Am I theoretically going to be assigned on these puts? And if I am assigned, what does that mean for my position? What that means is that you're going to be long the stock. Is your account set up in order to actually be long the stock? Or are you already short the stock that you can actually take delivery of that long stock and have a zero it out position? That's possible as well. Important to keep that in mind when you're thinking about it. The same pin risk exists here that exists on the call spread side. Pinning occurs when you get close to your short strike or close to your long strike. The difference is when you're close to your short strike, you don't maintain control of the situation. You are reactive, not proactive. Someone else is going to tell you whether or not you have a long or a short stock position, depending on whether you're short calls or short puts. And so it's important that you understand that when you're getting close to your short strike and it's getting like very, very close to your short strike, you need to understand what it means to be pinned and what it actually, the resultant position that you might end up with if someone actually exercises and you get assigned. So it's important to keep pin risk in mind when you're dealing with call spreads and put spreads, because pin risk exists when you have short options and long options in one position. You need to understand what that means and how it might affect the risk dynamics when you get close to it. Okay, this was a pretty basic coverage of call spreads and put spreads and spreads in general. I hope that we covered a good deal of ground, but we did it in a relatively effective way so that it wasn't too laborious. But I'm wondering if we have some time for some questions. Mr. Ken Keating, are you there?
Cashman, I am, and thank you for that presentation. I know there was a lot of information, and yeah, we've been getting some really, really interesting questions. So why don't we take the remaining 12 minutes and then go back and forth and tackle some of these live. So,
right.
You know, I want to bring up something, and you know, you were talking about assignment risk, and you know, the beauty about spreads is, you know, whether it's a debit spread or a credit spread, you know the defined risk nature of a spread. You know what you can make and lose up front. But one thing to qualify is that's only within the spread itself. So once again, if you get assigned or exercise one of your options, that completely turns the risk dynamics of that position upside down. So what if, like, all of a sudden, let's go back to that example where you're talking about you're short the 80-85 bull put spread. And,
yep,
you know, stock closes on expiration, stock closes at 90, okay? So you're thinking, well, God, both options are out of the money and they're going to expire worthless. So in theory, you would think you would keep the full credit that you sold that spread for, okay?
Yes.
But this is something that people, and we get questions about this all the time, and there is risk even on expiration. So if all of a sudden some bad news came out, and all of a sudden in the aftermarket, the stock, say, dropped to 70 points, somebody could theoretically still exercise that option that you are short, okay? So you still have assignment risk on expiration if you carry that spread through expiration. So anytime you're short options, I guess my point is, you know, the only way to truly avoid an unwanted assignment is to buy back any short options that you have on or before expiration, because that mitigates against an unwanted assignment. We can't talk about individual examples, but you know, this was probably a year and a half ago, maybe 2 years ago, and a very notable electric car company, which I can't name, but because we're not allowed to talk about specific stocks, but this notable electric car company dropped 100 points on Friday of expiration, And there were a lot of people that were either naked short puts or naked short bull put spreads that they thought were going to expire worthless. And they woke up on Monday morning assigned and long loads stock from 100 points higher. So I just want to bring that up, that there is a very real risk on expiration if a stock moves either up or down based on company news, which, I don't know, you want to talk a little more about that. It is a risk.
Yeah.
And I know not everybody's aware of that risk. So it's something I wanted to bring up.
I appreciate you bringing that point up. And let me address two things there. I think the first thing that I want to drive home is something that you said, which is kind of the overriding concept that we teach as far as risk is concerned, which is the only way to fully remove assignment risk is to close short option positions, right? That, I think, is the overriding idea of this whole situation, which is if you don't want to have assignment risk, you can't be short options, because any short option has assignment risk. You incur the obligation of making the contract whole, which is part of the reason why I started this entire presentation with breaking down, like, option buyers have rights, option sellers incur obligations. It's important that you understand the very basics of how these things work, because within a spread, you have both rights and obligations. So that part is really important. If you want to fully remove assignment risk, you have to close your short option positions. The second point that I wanted to bring to the top of this conversation is that you also need to make sure that you understand what the cutoff point is for your actual position as far as contrary exercise or assignment notice that you are able to give to your actual brokerage firm. And what I mean by that is there is a differing window for differing, brokerages where they will allow you to tell them, I don't want to exercise this option, or I do want to exercise this option. And you need to understand after it expires, how much actual time is built in before they tell you you can't tell them anymore whether or not you want to exercise it. The reason why is because some of those timelines are different relative to different brokerages. I can't, tell you which ones are better or worse, or which ones have more time or less time. We actually don't know that information. But the point of the matter is, if someone else has the potential to exercise their out of the money calls after the market has closed and there's an aftermarket move like the one you talked about in that stock, that you need to be able to understand, like, at what point is my risk completely off the table? Because that is going to be the cutoff at which your brokerage firm is going to tell you, you cannot tell us whether or not you want to exercise this option or abandon it from this point forward.
Yeah,
so that's important as well, right?
Right. So something that people should be aware of. So for OCC, for our member firms, we require that our member firms get their exercise notices into the exchanges by 90 minutes after the New York close, so 5:30 Eastern Standard Time, okay?
Correct.
I know.
So that's the latest, right? That's the latest.
That's the latest. Right. But your broker, depending on who your broker is, might not give you that window. I've heard of some very notable brokers that, and I can't name them, but have exercise cutoff thresholds that are as little as 10 or 15 minutes after the close. So it could vary anywhere from 10 minutes up to 90 minutes. So depending on who your broker is, and you'll want to check with your broker as to exactly what their policy is, it's going to vary depending on who your broker is. So it's something, yeah.
One of the things that I said, I did a webinar on this for a brokerage earlier, I think last year. And one of the things that I said in it is, trust me, I've been in a situation where I've been running around with my hair on fire, understanding that I got assigned on something, but didn't know how much time I had left in order to actually exercise the option that was below it. And you don't want to be in that situation trying to figure out when your cutoff time is at that point in time when the stock is moving. You want to know what that cutoff time is well before, so you can evaluate what your risk is most broadly and also most specifically as far as time is concerned and the strikes that you have on.
Right, and this kind of gets into one of the questions that I kind of set aside for you for the at the end. So a gentleman was talking about SPX options, and just say, let's say I'm short a bear call spread in the SPX, which for those of you who don't understand, SPX is the S&P 500 options, the options that trade on the S&P 500, the big options on the index, and they're cash settled. And if you're short a bear call spread, okay, since they're cash settled, it settles into cash. So if you're long an option that's in the money, it'll settle to the difference between your strike and whatever the settlement value is on the Friday of expiration, if it's a standard SPX, monthly option. But, this is why sometimes when you look at even though the last day to trade the SPX options is Thursday before the Friday of expiration, the settlement price is determined in SPX is determined by Friday morning on the opening. They take the opening price of all 500 components of the S&P 500 and they calculate what's known as a settlement price, or the SET price, and that's what's that bases the determining factor of what strikes will be finishing in the money or out of the money, and they're cash settled. So this is why sometimes, and you can talk this because I know you traded index options yourself, but sometimes on Thursday you'll see these out of the money calls and puts, and you're like, these things, why are they trading? Why the $10 out of the money calls trading for $1? And this is why, because you have overnight gap risk, and there's people that are trying to cover that short exposure, because if all of a sudden, what if all of a sudden the S&P 500 gaps open 20 handles or gaps down 30 handles on some, geopolitical news overnight? There is risk there. So that's why you'll sometimes see.
Yes.
Yeah.
Yes. Absolutely. I think the interesting part there is not only that the S&P might gap, but also that if you're dealing with those contracts that actually are AM settlement, which are the actual monthly contracts that settle in the way that you said they did, which is true, they actually settle on the Thursday, but they what we call print on the Friday morning. And so the print comes from all 500 stocks as they open. But keep in mind, right, as all those stocks are opening, the print is starting to come in bit by bit by bit, like the 300th stock, now the 301 stock, now the 302 stock, now the 303 stock, and they start to come in and affect the actual cash print, what we call the cash print. So there's not only risk in what if the S&P gaps lower? There's risk in what if one of the big giant stocks that are in the S&P 500 gaps significantly lower on the Friday morning and just prints in a super weird way, and that affects the actual cash print of the actual index. Right. Now, there's difference between AM settlement and PM settlement. The AM settlement is what we're talking about, where your options trade and settle on the Thursday for expiration, and then they print on the Friday, and they're based on the actual expiration. The cash, the transition from them being options into cash happens as a factor of the print on the Friday morning. But there's also PM expiry options that will print and expire on the PM print that happens at 3:15. So that's another part of that kind of index ecosystem of options. It's important that you understand which option you're trading and when it expires, right? And how it prints. That's important as well.
Yeah. So there are these little nuances when it comes to spreads, and I think we really want people to be aware of there. Even on expiration, there are certain risks if you choose not to close out your position. So kind of keeping on the same theme here about closing, somebody was asking about rolling positions. So what if all of a sudden your bull put spread is in the money, stock went down, it didn't go up, and now both options are in the money. If you do nothing, and both options are in the money, you're going to exercise your long, you're going to get assigned on your short, you'll lose the max value less whatever credit that you took in. But what if you are still bullish? What can you do? So, you could, trade out of that position and roll it to, a spread at a lower strike, or in the case of calls, roll it higher. So, once again, we can't really talk about what strikes to choose when you roll, but that's always something. Rather than just close the position, you could close it and roll it to a different set of strikes, take in, an additional credit, hopefully, you're going to be buying back the spread that you had for a debit, and then using the roll to offset that debit with a credit that hopefully you would take in, by rolling it lower. But I don't know. It's something you want to add about rolling positions rather than closing.
That's a good explanation of rolling, but also one other part of that you can think about is if you're closer to expiration and you don't necessarily have options strikes that are available below to roll it to below or roll it to up above. If you're talking about call spreads, you can also roll it out in time, right? There is a way to actually buy back the spread that you are short in the expiring month and sell the next month spread, or the second month spread, or whatever spread you want against it. In that case, you would be maintaining what would be viewed as kind of if you were short the put spread, you would be maintaining that neutral to bullish outlook on whatever the underlying was, but you would also be potentially creating more time for that outlook to actually play out by selling a spread that has a longer duration associated with it. So you can roll things within the same month. You can also roll things out into other months and change the duration of your option spread as well. Make sure that when you're thinking about doing that you factor in things like potential slippage and associated fees with buying and selling, because in that case, if you had a spread on and you were rolling it to another spread, you're going to be dealing with 4 different strikes and essentially four different option trades. It may be priced as one spread, and it may be, you may see the price of the spread transaction as one spread, but you're probably going to be charged on all 4 legs. So make sure you build that into the actual risk matrix that you're dealing with as well.
Right. So, and I just want to mention to people, we are at our time limit, so I'm going to hand it back to Matt and let him finish up. But just so you know, we are still getting questions. So if your questions did not get answered today, somebody on our team will reach out to you tomorrow with an answer to your question. So just so you know that all questions do get answered. So if you didn't get your question answered today, no need to worry. Somebody will reach out to you with an answer to your question. So once again, Matt, thank you again for that great presentation, and I will let you wrap it up.
Yeah, absolutely. Thanks, Ken. And I appreciate Ken and Roma, you guys working behind the scenes and answering those questions as they come in. Make sure, everyone, if you do have questions, like Ken said, you can also send them to options@theocc.com, which you see right here on the screen. That's a service that we provide, again, free of charge to the public, where we answer options-related questions on a daily basis. And next week, Wednesday, at 3:30 Central Time, we're going to be building on everything we talked about today and building it into a little bit more of a complex idea of how spreads how you can trade more complex spreads using the actual ideas that we built on today as far as the understanding of the inherent optionality. So make sure that you tune in with us next Wednesday at 3:30. Well, I will be giving the sister presentation to this presentation, which will be on complex option spreads and the optionality there. We hope to see you there. I hope you enjoyed it today, and we will see you next week. Thanks again.